What is commercial paper in shadow banking history? Imagine a world where companies can borrow money quickly without going to a bank. That's where commercial paper comes into play. It's a short-term debt instrument issued by companies and financial institutions to meet immediate funding needs. Usually, it lasts for 1 year or less and promises to pay a specific amount at maturity. It's like a promissory note but without collateral backing it up. Commercial paper has been around for centuries. Back in the 19th century in Britain, similar instruments called commercial bills helped support trade and economic activity. Over time, these short-term loans evolved into what we now call commercial paper. It became a key tool for businesses and banks to get quick cash without the hassle of traditional loans. In the context of shadow banking, commercial paper became a central piece. Shadow banking refers to a network of non-bank financial entities that perform bank-like functions but aren't regulated like traditional banks. These entities include investment firms, hedge funds, and money market funds. They needed quick and flexible ways to fund their activities, and commercial paper fit perfectly. During the late 20th century, financial innovation and regulatory changes encouraged these non-bank entities to lend and borrow outside the traditional banking system. Commercial paper allowed them to raise funds from investors without relying on bank deposits. It was a fast, efficient way to get short-term money, often used for financing day-to-day operations. Most of the commercial paper issued in the United States comes from financial institutions. It's a major source of wholesale funding, which is less stable than retail deposits. During the financial crisis of 2008, this became clear. When Lehman Brothers declared bankruptcy, it defaulted on its commercial paper, causing panic. Investors rushed to sell their holdings, leading to a market freeze. This event showed how vulnerable the shadow banking system could be when heavily reliant on commercial paper. Non-financial companies also use commercial paper to meet liquidity needs. They typically issue unsecured notes, meaning they don't put up collateral. While this helps them access quick funds, it also carries higher risks if their financial situation worsens. The shift toward market-based funding like commercial paper reflects a broader change in how credit is created and managed. It moved some financial activity away from traditional banks to the wider market. This increased credit availability and fostered innovation, but also introduced new risks. Unlike banks, these shadow banking entities don't always have access to central bank support or deposit insurance, making their funding more vulnerable during economic downturns. In summary, commercial paper in shadow banking history is a short-term, unsecured debt tool that helped non-bank financial entities fund their operations outside traditional banking rules. It played a key role in the evolution of financial markets, offering new opportunities but also exposing the system to potential instability when market confidence faltered.